Is it a dividend ETF or a growth ETF that will make you rich? I made over $75,000 investing in ETFs, which has helped me build my over $1 million real estate portfolio today. I'm Rosie. You just gotta do it scared. It's so easy to feel overwhelmed with all the information that's out there, but don't worry, we're going to easy school today. By the end of this video, you're gonna be walking around like, are you investing in dividend ETFs? Are you investing in growth ETFs? Yeah, we're leveling up. So an ETF stands for an exchange traded fund. And I like to explain it as the plate of food that you get at a party, right? You get a little bit of jollof, Ghana jollof. I saw that comment about Nigerian jollof. You get a little bit of meat, you get a little bit of salad, you get a little bit of sauce. You put that all together. That one plate in consumption as a party in your mouth, let's think of that as one ETF. Meanwhile, maybe somebody has a lot of allergies or something, and they might just get a plate of rice. That's it. That's all they ate. They just consumed one stock. I'm just using that food analogy to help you understand how an ETF works versus an individual stock. I'm all for ETFs. I'll put the video at the end as to why I explain an ETF could be the better option for you, because you're a busy boss and we want to mitigate your risk as much as possible. So what are the types of ETFs? We have a dividend ETF. Now, dividend ETFs, look at this handful of rice, okay? Think of this handful of rice as many companies coming together as one ETF. When you invest in an ETF, you're investing in a bit of many different companies. So anytime that you buy more shares of this ETF, these companies, as they grow, you see how I'm increasing it in this hand, they meet their quarterly goals, they in turn pay you a little something through the ETF. This could be monthly payments, this could be quarterly payments, and just like that, this is your dividend. One thing about dividend ETF, these stocks in the ETF, they tend to be established companies. So they usually go up in value very slowly, unlike a growth ETF. Let's go there. Now, growth ETFs are a bit different. Instead of focusing on companies that pay dividends, they invest in companies that are expected to grow at a much quicker and larger pace than dividend ETFs. So growth ETFs invest in companies that are expected to grow a lot in the future. Here's why I used rice, and I had to come bring it and show it to you. Think about the process of cooking rice. When you cook rice, what happens? You basically expect it to practically double in size. Now think of your investment as the water that cooks the rice, with the expectation that you're gonna have some fluffy, delicious rice at the end of the cooking session in the future. Stay with me. But sometimes you don't add enough rice. The stove is too hot. So many different elements can happen. Where am I going? Only invest money you're willing to lose. Because how painful is it to put that rice on the stove and you forget about it and you go back and it's burnt, or there was not enough water, because things can happen. Now that's how I want you to think about when I talk about volatility in the market. So growth ETFs will be a bit more volatile than dividend ETFs, but not as volatile as individual stocks. Are you with me? So that means that growth ETFs have a higher potential for higher returns because there's a little bit more risk there. Me personally, I love a good growth stock. And if it also plays a little bit in the dividend space, yeah, sign me up. I'll tell you one. Stay tuned. Let's break down the pros and cons of a dividend ETF and a growth ETF. So the three pros I like with a dividend ETF is, one, you get paid regularly, typically monthly or quarterly payment. It reminds me of like if you like did a movie and years down the line you're still receiving those checks in the mail. That's what a dividend ETF payment feels like. It's predictable, so it can be really good for planning, and you can reinvest the dividends to allow your money to grow even more. Dividend ETF gives you kind of like that regular paycheck feeling. So if you've like retired, or even if you're an entrepreneur and you've gotten some funds that you want to put in the market, you could look at dividend ETFs to kind of start creating that consistent payment for yourself. It also reminds me of like the tenants that I have in my portfolio that use the different programs to help them pay rent. Those programs do not pay like clockwork. On the first, boom, the money is in your account. It gives me a little feel of what dividend payments can look like. But the two cons that I have with dividend ETFs, and I think I touched on this a little bit earlier, companies that typically pay dividends don't tend to grow as fast because they also tend to be quite established companies. I mean, think of like a Coca-Cola versus an Nvidia. The value of a dividend ETF is not going to explode with growth, but you're getting those checks though. Oh, and you might have to pay taxes on your dividends. You gotta feed the golden goose that pays you. I believe when you're young and able-bodied, this is the time to use your skill in a manner that aligns with your purpose purpose to create value in the marketplace and generate more income so you can build a stronger nest egg that 10 years from today, you lift your head up and even want to take a sabbatical for a couple of years and it wouldn't even affect anything. For me, I believe dividend ETFs are great if you're nearing retirement or just love the idea of receiving some money for owning stocks. But remember, the trade-off is you might not get as much growth in the value of the money that you invested in the dividend ETF versus that of a growth ETF. Let me give you some real world context. I did some research and a good dividend ETF to look out for is JEPI. It's by JP Morgan. It's JP Morgan's Equity Premium Income ETF. It's a pretty popular dividend ETF. It pays around 7.5% each year. So if you invested $1,000, you get about $75 over the course of the year. It's not bad for really doing nothing. It starts to become kind of real income when you invest more into it. Another one is Vanguard's High Dividend Yield ETF, VYM. This ETF focuses on US companies that are known to pay dividends. Over the past decade, VYM is known to have paid about 3% in dividends each year. So if you were to put $5,000 into this ETF, you're looking at about $150 coming into you each year. Here's another one, iShares Select Dividend ETF. Its ticker symbol is DVY. This ETF targets companies with a very strong history of paying dividends. It's been quite popular amongst investors that are looking for dividend ETFs, and it typically yields about 4%. So if you were to put in $5,000, you're looking about $200 coming in annually. Now let's talk growth ETFs. This one excites me because this is really where I saw and understood to be patient, to be consistent, and let money do its thing for me. Okay, so growth ETFs focuses on companies that could grow a lot over time. Now this is important when you're deciding between going for a dividend ETF or growth ETF, because if you're somebody who now understands how the markets works and you can ride the waves of the ups and downs, you will more likely to win with a growth ETF strategy. But I also understand that the value of my portfolio could go down drastically. However, I will continue to dollar cost average. I told you about that, which is consistently buying shares every single month. If you've got this far and you mean business, which I know you do, put ETF in the comment. Put ETF. As a matter of fact, let's be more specific and let me know if you're down for a dividend ETF or growth ETF. Let me know in the comments. So the 3 pros that I like about a growth ETF: greater potential for greater gains if a company grows a lot. This is what I happen to take advantage of because I had a couple tech-focused ETFs in my portfolio. This means your investment, the value of your investment, could be worth so much more in the future. And with growth ETFs, it often invests in innovative companies. So you could be investing in the next big thing. And because we're leaving our money there to grow and we are focused on long-term investing, taxes can be very minimal until we actually sell in the future. But if you're here and you haven't got a little whiff of real estate investing, because that's how I'm really stacking the bets in my favor with whatever I'm investing here in the market. Real estate is going to take care of me from a tax perspective. Do you get? We can talk more about it. So when I talk about making that 75+K to help with real estate investment, if I had just taken that money and had a good time, taxes would have hit it real hard. But guess what? Because I had a real estate portfolio, did I owe taxes on that transaction when I took my profits? Yes. Did I pay it? Not really, because real estate came in and did its thing. I'm not going to go in detail, but I'm pretty sure you know some of it, and I can do a video that even explains a bit more on how real estate can hedge the bets for you with your taxes. Now, growth ETFs are perfect if you don't mind a little bit of, a roller coaster ride and you're in it for the long haul. And I mean, that's why you're here. Hit the subscribe button because we're building foundational wealth for the long haul. So because these ETFs can be a bit more volatile, you might shed a couple tears, but you're not going to, because we don't invest with our emotions around here, okay? Because we understand the market and what it is doing. And I always think, like, if you are in a panic to sell, especially when the market is dropping, that should be a flag for you. That should be a light bulb going off to tell you that you are not yet in a financial position to be investing that much into the marketplace. Okay, so here's some of the examples of the growth ETFs that I talked about. Did some research, look at those key elements like expense ratio, history, how it's performed, and so forth. Look at QQQ. That's Invesco's QQQ Trust. It's an ETF. It's packed with the heavy hitters, your Apple, your Amazon, your Google. Over the past decade, the QQQ has averaged a return of about 17.4%. That's not something light to sleep on, but let me show you how volatility works in the market. In 22, in the stock market, it took a hit and the value dropped over 30%. So why this up and down, this roller coaster, right? Well, QQQ, sounds like I'm saying the fraternity. Hey, please, this is just educational platform. Let's focus. So QQQ holds around 100 companies. Many of them are in the tech sector, right? And we all know what's going on with tech, from the changes to different markets competing with AI in the US market, with companies taking new technologies to replace even jobs or things like that. Some can be a good hit in the market and some might not catch as well. So if you think of it, ETFs that have hundreds of companies in it, they're not going to be as volatile as one that maybe just has about 100. You might think 100 is a lot, but in ETF world, no. So a $5,000 investment in an ETF like QQQ could grow nicely. But remember, it's not a sure thing. And that's why I like thinking about my investment portfolio as the best strategy that fits me. And you have to create a strategy that fits where you are and what your financial goals are, right? You don't put all your eggs in one basket, but you pick the right baskets, the right plate of foods, and fit it in as a puzzle piece to work for you. Okay, so look at this. If you were to invest $1,000 in QQQ today, it'd be worth about $1,200 in a year and over $2,200 in just 5 years. This is the power of compound interest. Imagine you had 10, 20K in this ETF. And I've got more videos. We going in depth. We're learning about the basics and we're hedging the bets in our favor. So stay tuned. I'll put one at the end for you. Another good growth ETF to look into is ARK Innovation ETF. ARKK. Okay. It's managed by ARK Invest. This ETF invests in companies that are leading in innovative fields like genomics, automation, robotics, and what your girl used to work with in tech, some artificial intelligence. So this ETF, ARKK, it focuses on trying to target emerging technologies and industries that are poised for significant growth and advancements. So think of like Tesla, Roku, Square. And I'm actually glad I mentioned Tesla because even though a company might have perspectives for growth and advancement and things like that, we're seeing in real time how the court of public opinion can actually influence the value of a stock. So I put these examples in here to show you that don't sleep on growth ETFs. It can really take off. But then also, I gave you some really real life examples to show you how volatile it can also be. Another example of a growth ETF is SPDR S&P 500 Growth ETF. Its ticker symbol is SPYG. So this one, it targets fast growing companies in the S&P 500. And just like I'm talking about volatility, in the past few years, it's had a really bouncy ride, but it's bounced back. And a 1-year return is over 20%. And I kind of like this one because it also pays a little bit of a dividend, right? Remember I talked earlier about dancing in both sides? Heavy on the growth, give me a little dividend as I use my skills now to continue to build my cash flow and allow for money to grow. Then later in the future, by God's grace, we're going to also enjoy some of those dividends. So SPYG could be a good one to look into. Okay, now I told you that I really like ETFs that know how to straddle the fence between a growth ETF and the value that it offers and a dividend ETF and the value that it offers. My number one is VOO, okay? There are a few other ETFs that kind of straddle the fence really well, just like VOO, like IVV. It's iShares Core S&P 500 ETF. But let's focus on VOO. So VOO is actually a dividend ETF, but it's not all about the dividends. It tracks 500 of the biggest US companies. Many of these companies pay dividends, so VOO in turn pays a little dividend. However, VOO's main goal is to follow the performance of the S&P 500, the growth, not to provide high dividends. So the money that they'd pay you in dividends is not as high as some of the examples that I gave earlier. The reason I like it is because investing in VOO means you're betting on the success of the biggest US companies, which can be a solid strategy for long-term growth. Are you with me? Oh yeah. By the way, all these ETFs I'm mentioning, you can easily buy them through your preferred brokerage accounts. I mean, we've talked about Vanguard, Fidelity, Charlie Schwab. I mean, the list goes on. So which should you choose? Let me know in the comment which one really strikes you or the one that you've invested in. For me, it depends. I do lean more growth ETFs, but I'm very intentional on creating a wholesome investment strategy that works with my financial goals. So that's really what I want you to keep in mind. Understanding where you are in life, where you want to go, and how do you take the puzzle pieces to fit together to make perfect sense for you. So maybe you're looking for an aggressive growth strategy that allows you to be able to cash in some money and use it for other investments. Maybe a heavier growth strategy would be best for you. If you're nearing retirement or if you're needing consistent cash flow coming in, dividend ETF could be a heavier investment strategy that allows you to reach those goals. What we're not doing over here is not taking any sort of action, not doing anything, because that's not an option for us. We're understanding understanding the basics, and we're investing in ourselves. We're building so that money never becomes a problem for us. And coming from somebody who thought they were going to make $1 million overnight and has lost money pursuing something exciting that someone sold to them, I can tell you that you're not making $1 million tomorrow. However, you can put the foundational things in place. You can leverage your skills to build value in the marketplace and understand how money works. The more valuable you are in the marketplace, the more you attract money to you. And the more you steward that money, the more it will grow. Yes, we can all see $1 million in our bank accounts. It's very feasible, but we have to follow the principles of money and invest it wisely. You have the power to change your financial future. It starts with you. I believe in you. Oh, and by the way, you asked and I went to work. I created the ultimate ETF investing guide. I'll put the link in the description. It's accessible and available to anybody. Get it, start understanding some of the fundamentals, and start investing. I'll send you a hello back in your email. So if you're looking for an even more in-depth step-by-step process to create a strategy around your investing, I'm working on something. I've gotten some folks interested who've reached out. So I want you to be plugged in and stay tuned. I've made a video here for you to learn more about investing. I'll see you there. But you know, around here, we do it scared. When I was scared.